Hello and welcome to your Money or Call, a shocker of a day on the Australian share market today, with the All Ords down some 2.2% to 5690 points. Now almost 5% off the yearly high only 8 days ago. Poor result from the Commonwealth Bank precipitated the rout, with CBA shares finishing down almost 6% actually at $82.98. This was a stock that was above $90 some 7 or 8 trading days ago. The poor sentiment spread across the whole market today, with every sector finishing in the red. Hello, I'm Ken Bloomfield from Financial Clarity. Joining me on the panel tonight is Jeremy Hook, an old regular from TMS Capital, and Gary Stones, another old regular from Share Wealth Systems. Welcome, gentlemen.
Thanks, Ken.
Big day on the market today.
Big day, wasn't it?
Yeah, it was, and a bit of a shock really after the interest rates came down yesterday.
Yeah.
Wouldn't really expect the market to be down over 2% today, and wouldn't expect the dollar to be up over 1%.
Yeah.
What's happening out there, Jeremy?
Well, it's really interesting because it was the interest rate decision that people in the share market wanted yesterday, but it's where the interest rates are set in the market, the bond market, where all the unwinding is coming from. So obviously, over the last few years, with rates going down, everybody's been of the view, or at least 80 to 90% of the market participants of the view that the interest rates are still going down. When they decide, because interest rates will go up eventually, that rates are going to go up, there's going to be some adjustment, some pain, some volatility. And we saw part of that today and yesterday, and we're seeing it at the moment. While there's a bit of the snapping in the psyche that, in fact, rates will go up, so bond markets have been sold off aggressively, and we're part of that mix, so we've been sold off as equity investors as well. But, of course, I mean, the market's had a good year to date overall.
Yeah, absolutely.
And it's creating some value opportunities that haven't been there all of 2015.
Yeah, we need corrections, don't we, so we can buy well.
Yeah, exactly right.
Yeah. And what do you think, Gary? Are you a similar view to Jeremy, that it's mostly
absolutely.
about long-term rates?
Yeah, this is not the start of a 2008 bear market by no means. The overriding philosophy is going to be interest rates are low. You're going to have to take some risk to get a half-decent return. And the only place you can get that really is in the stock market. Sure, you can get it in property in pockets, but in the stock market it's been fairly easy, where if you've just gone for large cap stocks with yield, you've been pretty close to the money. Yeah. And a
few of those stocks today got really smashed. So CBA got smashed 6%.
Not only a few, a lot.
And Woolworths 5% today.
Absolutely. Yeah, and those are the two they're saying accounted for 30% of the fall today, just two stocks. Woolworths has been on its nose for some time. I picked it as a sell on the buy hold sell segment last month, I think, when I was here. And but the CBA, everybody's been saying, when's it going to top out? When's it going to top out? And CBA was down 6% odd today, but Westpac's taken a smash over the last 10 days.
I think they're down 7.5%.
Even more, I think. And just looking at it, I mean, they've really taken a pounding. But it's the overriding philosophy here of from a big picture point of view of investing is it's risk on in equities. That's really what it is. So people should be looking at this as a medium to longer term buying opportunity, not the beginning of a big sell-off where we're going to see 1,000 points come off the index or something like it. I think that's the way you should be looking at this.
And Jeremy, you're of a similar ilk there?
Yeah, look, absolutely. I mean, I think what it does come back to is that you do want to have some. And we spend a lot of time, I know, ourselves doing having structure in a portfolio, having asset allocation, having a bit of cash, and opportunities like this you look for. And you want to be able to take advantage of it. So things that have been belted today, I've been sitting around watching for, weeks, months, waiting for prices like this. And it can be a very frustrating time just sitting there watching when you don't really want to buy because the price doesn't meet what you value a stock at. But when they
it's about patience though, isn't it? And also, just as you say, having a plan, it's so important. Great majority of new investors that I meet in the SMSF market don't actually have a plan. They don't have a written plan for how they're going to invest the the money. They might have something for their super fund, the one-pager, but they need something much more than that, don't they? They need a strategy so that they're ready at to take the opportunities when they come up.
Yeah, because that prepares you for days like today and these kinds of markets.
Yeah, good. Fantastic. Now, if you have a question about shares, our phone lines are open on 1300 30 34 35, or if you prefer, you can email us on yourmoney@skynews.com Now, gentlemen, just before the break, we might just go with a couple of those other stocks today. One of them is Woolworths. It really got smacked. What's your feeling overall on Woolworths?
Today was a big opportunity for them to sell the 3 to 5 year story because they've missold the stock to the market. They sold it as a growth stock with the real engine of growth and the high margin capacity of the masters and home improvement businesses. That's been an abject failure to date, but not surprising, to be honest. I think the only thing that we should expect from that business is it'll be a 10-year investment before they get a proper return from it.
Right,
and that's still another 5 years to come, people. So
it's a long time away.
I think that's it. Just keeping the faith. They've got good businesses. They've been they had a very good run for 20 years. It's come to a bit of a difficult part. There is a way forward for Woolworths, but the next year or two is going to be a lot of hard work to get there. And I do think the idea of getting into the home improvement space makes sense. There's bigger margins and a very fragmented market. Surprisingly, Bunnings has only got about 23% market share.
It's amazing, isn't it?
It is,
they're so dominant in our minds, but only 23% market share.
And Woolies also owns the Home Timber and Hardware, which is still contributing more in the way of revenue than Masters to the overall group. So they do have a strategy. It's taking time. It's going to take more time. You can, if you're a short-term investor, it's not going to give you a lot of joy, I don't think. But
We've just had two stocks that have gone down today. We might go straight to a caller. We have Barry calling from Brisbane. How can we help you, Barry?
Yeah, g'day, how you going?
Very well.
I guess a simple question about Woolworths. I guess everyone's bashing Woolworths at the moment, and I see it as a good long-term stock, but how low do you think it'll go?
Okay, Barry. Well, okay, we get the first question on Woolworths. We were just talking about it. That wasn't a Dorothy Dix question, viewers, but thank you, Barry. Look, I'll just put my 10 cents worth in to start the conversation. I think Woolies has a long way to go. I read a survey last week that came out, very interesting. It's the Mr and Mrs Australia survey, they call it, the retail survey. 2 years ago when I read this survey, Woolworths was in front of Coles in 6 of the 8 categories that they measure in terms of how shoppers basically view the two businesses. And this one that just came out, they were behind in 6 to 8 of the measures. They really have lost a lot of ground, and my feeling is that it's going to take a couple of years to turn this ship around, which Jeremy was mentioning. I would not be buying the stock now. If I was actually in the stock, I don't think I'd be in it any longer, and our target is somewhere between $22 and $24 before we'd be interested. So, Gary, with that having been said, what's your view of Woolworths?
Well, technically you've picked the spot right on over there. There are a whole number of technical support levels and Fibonacci levels that tie in at the low $23. So you can look at it. It's been in a range since 2007. It popped out the top, so it extended that range a bit when it made a high during the course of last year, about halfway through last year. But the bottom of that range is $23. So it's in a range between sort of $36 and $23. When it popped out the top, there was a chance then that it could have actually broken out and continued its trend up. It hasn't. It's going to move to the bottom of that range, I think. So it's heading down at $23. And the way the stock moves, I don't think it'll get there quickly. And when it gets there, I think it'll need to base for a while, for it's certainly a few months, 2-3 months, and then maybe start heading its way technically back up, if nothing else changes fundamentally, back up to the 32 level mark. But it's going to take, it took to get from $23 to 36 last time, it took 2.5 years. So factor in the fact that it's still got to get down to 23 and then turn and go up. You might be talking 3 years before, 2.5, 3 years before it gets to go and challenge its all-time highs again. At which time, from 2007 to 2003, it's going to be 10 years before it makes a new high and continues its trend. Now there is better value out there, and that's what people should be looking for.
Fantastic. Now, thank you, gentlemen. Comprehensive one there on Woolworths. We now have another caller, George from Melbourne. George, how can we help you tonight?
Yeah, I'm ringing up for a company called Unity Mining.
Unity Mining.
Yeah, technical. This company, 2005 was $2-3. It came right down to less than a cent. In the last few months, it's been going up, and I noticed today they had quite a big volume. Is it time to get in this company again?
Okay, thank you, George. So that's code UML, Unity Mining. Now, we're looking for a technical view here, Gary.
Yeah, I think that's the only view you're going to get. There's no fundamental view on this one. It's
a lot of profits there, I'm guessing.
Did 200 million shares today. It went from 1.3 cents to 1.5 cents. So, percentage-wise, it's a great jump. But if you look at this chart, percentage might be big in one day, but it's got a long way to go still to prove itself. I mean, I wouldn't be getting into the stock until it probably gets above 2.5 cents.
Right.
Now, that from here to there, that's a 60% rise from here.
Okay.
but if you're, I'd be taking a sort of a medium-term view doing that. But if you're a short-term, this is obviously the short-term players where you don't want to be putting too much money in. The average liquidity on this stock has been it's been averaging about $30,000-$40,000. So take 1/10 of that. If you take today's volume out, which is obviously a bias, it skews everything. You shouldn't be putting more than $4,000 or $5,000 into this, really. So if you want to play it sense,
depending on the size of your portfolio as well.
But not even depending on the size of your portportfolio. I mean, if you're a really small player, then you'd be taking even less than that. But
that's what I was getting at,
it'd be a maximum of $4,000 if you're putting into this, right?
Yeah.
And you've got to say, okay, well, how much am I going to make out of that? It really is for the bit short-term traders.
Yeah. And would you have more fun down at Randwick at the races?
Well, people get fun out of this, I mean, they used to go on the Big Dipper when they were kids, at the amusement park. But, that's what this is. This is riding the Big Dipper.
Yeah, at least you don't get a queasy stomach, eh? Or maybe you do looking at a chart like
have a bit of fun. But, as long as they've got their main stuff sitting in some of the other stocks.
Sure, yeah. Okay, thanks, Gary. Now, we'll be back with more after the short break, but if you'd like to speak with our expert panel, call us on 1300 30 34 35 or email yourmoney@skynews.com.au.
Down here, there's a lot to take care of. There's the meetings, the deadlines, the phone call you promised your mother, your gym bag full of wishful thinking, and your 2-hour park in a 1-hour space. But up here, everything's taken care of.
Shiraz or Riesling, sir?
Especially you.
Shiraz, please.
With food, checked baggage, and entertainment now complimentary on Virgin Australia domestic flights.
We love watching patterns. We love spotting the little things that shouldn't be there. That's 9 so far. Our intelligent security systems can detect something odd in your spending pattern, helping to stop fraud in its tracks. Just part of the shopping with confidence service we deliver daily. American Express. Realise the potential.
This is the future of mobility. This is reimagining the realms of possibility. This is the BMW i8, and it is these ideas that drive innovation in the BMW 5 Series. With BMW connected drive features such as lane departure warning and head-up display, you can experience the ideas of tomorrow today.
When you need to get in, get out, and get on with it, you can't beat Mighty Helpful Mitre 10.
Rockwell 18-volt drill driver combo, $99. Gasmate patio heater, hot price at just $129.
That's Mighty Helpful Mitre 10.
Anton's Animal Kingdom.
Anton.
How may I help you?
Help.
Be quiet.
Quiet.
Silence.
If only everything was as easy as creating your website with Wix. Go to Wix.com today. It's free.
By 2030, nearly 60% of us will call cities home. And if we're going to meet our needs, we're going to have to rethink so many things that touch people's lives.
So, how do we get there?
For us, the answer is social innovation that uses our advanced solutions along with IT to help create a social infrastructure for generations to come. Hitachi Social Innovation.
It's our future.
Hitachi. Inspire the next.
The Prime Minister says it won't hurt, but the Treasurer says it still needs to. So is this year's federal budget all about sacrificing a surplus for their survival? On the next Cabinet, we'll share our own real-life experiences on Sky News Live.
Welcome back to the Shares edition of Your Money, Your Call. I'm Ken Bloomfield from Financial Clarity. With me tonight is Jeremy Hook from TMS Capital and Gary Stone from Share Wealth Systems. We're still taking your calls, 1300 30 34 35, and emails, yourmoney@skynews.com.au. We'll go straight to another caller. We have Marco calling from Melbourne. Marco, how can we help you tonight?
Hi, gentlemen. Thanks for taking my call. I've just got a question for Gary. If he can give me a technical view on AZK, Asiana Limited. The stock has had a recent run from 5 cents all the way. It spiked up to 62 cents on big volume, and it's pulled right back recently, and it's closed today at 27 cents. Just wondering if today's close is a good entry point, or how he sees this going in the near future. Thank you.
Good, thanks, Marco. Now, Jeremy, just quickly before we go to the technical view, you said you saw this stock running, and it's a bit of a switch from mining to.
That's it. Yeah, it's what we call the backdoor listing, where it used to do one activity, in this case mining, and it's moved away from that by buying a business in which happens to be neural technology called BrainChip. Now, that's the sum of what I know about the company, Ken. But
excellent. We'll go straight to a technical view. Thanks.
Right, the technicals, you've given us the technicals to continue, the prices, to continue putting those prices into a technical perspective. What I'd look to do here, and the way to play this, is look at how far the price is retraced from its high. So it started off at 2 cents, not 5 cents, in the middle of March. So you're talking 6-7 weeks has gone from 2, peaked at 62, and then it's retraced. Now that retracement is sitting right on a 61.8% Fibonacci retracement, and it's tested that level once already, risen back up to the 38.2, and it's now testing that 61.8 at the moment. So the way to play this is if it's going to continue its trend, the way you play it is buy now, buy tomorrow, near the open, soon after, and have a close stop. And the stop, although it's close, price-wise, percentage-wise, it might be a little bit too big for some people, but if you're playing this end of the market, I suspect it won't be. But your stop would need to be at around about 23, 22.5 cents. If it gets there, fall out. It means that the retracement's going to go further and could go all the way back down to sort of 8 to 15 cents. So put a close stop. If you are correct and it bounces, you could look at the stock, at least doubling. So you're looking at maybe giving up 10 to 15% versus a doubling from where it is. So that's the way I play this. It's obviously not a buy and hold. You're not looking to hold on to this for weeks. You're looking at holding on to it for days.
Yeah, and again, capital management also very important.
Absolutely. And what percentage of your portfolio you're going to put into this? You must look at that. It's obviously a high risk environment, high volatility. From a volume perspective, the liquidity, it's gone up to 3 million. So it's turning over a massive amount in a short period of time. So there are a lot of people playing this. There's a lot of people playing. So you won't have an issue with position size in terms of getting in and out in the short term, but you should make sure that you don't put too much of your portfolio into it. Yeah.
Good. Thank you, Gary. I hope that was helpful, Marco. Now, we will go straight to a viewer email from John. John writes, we're hearing a lot of negative info on the banks. You certainly are in the last few days, John. Whilst there's likely to be limited growth amongst them going forward, surely they're worth investing at the right price for yield, which for some could be back up around 8 to 10% grossed up. So grossing up meaning that once you count the benefit of the imputation credit, they could well be above 8% again now. Some of them, certainly NAB, I believe. Similarly, we'd like to have your advice on WOW, or Woolworths. Now, that's a couple of stocks or a couple of sectors we've already spoken a little bit about. But, Jeremy, I think it's worthwhile just here making sure we're very clear about the timeframes for this, because, we've really just gone negative on the banks in the last couple of weeks, the market. And I think it's important that, long term, of course, bank leverage or bank share price is leveraged to volume growth of loans, right? Long term. In the medium term, though, there are a lot of other things affecting the stock price. So what's your sort of view in that sort of short to medium term, and then maybe taking that longer term perspective?
Yeah, look, I think banks are still very investable. I think they're good to hold. They're a good part of a portfolio. I think you do need to have a reasonable weighting, not a massively excessive weighting to the banks. I think what's been evident in today's CBA quarterly and the half-yearlies from Westpac and ANZ is that there's competition, and the competition's hurting. Revenues aren't rising as fast as costs, and they're trying to buy each other's businesses. So while they're doing that, not every single bank becomes a winner. So we tend to always talk about them as a homogenous group of banks. Look a bit closer and see which are outperforming in the key categories. And like Ken said, lending volumes are going to be the key. In particular, you're going to see a lot of refinancing given a rather healthy local property market and businesses which are changing over. These are good signs, but I don't think all four are going to be winners in the same way. So there'll be a bit of win, bit of loss. What I noticed was Westpac surprised me more than others on the downside. ANZ wasn't bad. Commonwealth, not too bad, I don't think. But again, expectation was high with high share prices, and the disappointment was obvious in the sell-offs that we've seen this week.
Good. Yeah, thank you, Jeremy. That's some good sage advice there. What do you think there, Gary? It's been a real favourite of the investors, and I guess it depends a little bit too whether you're actually overweight banks at a starting point or whether you're underweight. So I think we should make that point because a lot of SMSF investors that I've met in the last couple of years are very overweight banks.
I think that would be typical. Certainly the people I talk to who've got long-term buy and hold portfolios hold at least 2, maybe 3 of the banks.
Yeah.
So it's a typical self-managed super fund portfolio would be overweight in the banks. I think the situation we're getting to now is they've become more and more difficult to buy at the banks just because the prices we're getting up there. And at the end of the day, it is a price game. I know it's value in the long term, but when you enter and when you get out, it's at the end of the day, it's price. And I think they're becoming more, use the word investable, I think they're becoming more buyable. Certainly CommBank is at a level now where you could have bought it at this level 9 months ago, and it's given it all up in about 4 or 5 weeks, from 96 down to 82. So there's a support level, a very strong technical support level at this 82 to 83 level. If this doesn't hold, there's another very strong one at 78. So the short-term little bit of a gamble, if I can use that as in terms of getting an entry, I think it's not a bad idea to be, if you're not in banks or you're underweight banks, to be getting into banks, and you're getting close to buying time. You really are.
Yeah.
And if you wanted to, if you were happy to see it go down to 78, having bought at 82.50, then that's fine. Just another $4 on CBA shouldn't be too bad. If you want to take a little bit of a gamble and hang out there for a bit more, it could go down to the high 70s, in which case you just get a better entry. Certainly people who are in banks and might have been top heavy and now their weightings come down a bit, that might be an opportunity to maybe get a few more. Yeah.
Good. So thank you, gentlemen. The only other things I'd say there on the banks is firstly, we actually took the view that CBA was getting too high above $90. We rotated out of it across to NAB. Jeremy was talking about this with the winners and losers within the sector. NAB was almost 20% cheaper on the basis of PEs, yields, almost everything. And in terms of meeting these capital adequacy ratios, they've got some capital which is going to be coming from both UK and US to help in that regard. So that's just a bit of an idea in the short term. We're comfortable that NAB now should have a reasonable run after a very poor run over the last 5 to 7 years. Now we'll go straight to another caller, Anthony. Anthony from Melbourne. How can we help you, Anthony?
Well, I wonder what's the expert's opinion on Mesoblast. It seems that when there is an announcement, the share goes up significantly. After a few days, it drops back again.
Yes.
And I had a comment from one of the commentators before that could it be the new CSL?
Okay.
I have my doubts now.
Thanks, George. Yeah, Mesoblast, gentlemen. Now, this is a stock that is pretty interesting. It's doing some pretty interesting things. It does tend to, as per its name, sort of blast off when the announcements come, and then everyone sort of seems to forget about it, and it drops back down. So it's not a stock we're in at all. But Gary, do you have a technical view on Mesoblast?
Technical is not looking good at all. It still looks very much like it's in a downtrend. The only positive I can find is that it's at quite a significant Fibonacci retracement level, which is a 61.8. But it's not showing any signs of turning around yet. The trend's still down. I would be waiting for this to get above $4.50, which is a long way off the 375, 374 at the moment. So there's no early indications. You'd be taking a guess, really, and trying to bottom pick it.
Okay.
I'd be waiting, yeah.
Good. And Jeremy, is this one you follow at all?
No, Ken. And again, I don't think it's well held by retail. It's not an easy stock to hold. It's not profitable, which makes it harder. One thing though, the caller did make a very good point on is it's very news driven. Its share price activity. There was an equity stake taken by a big pharma company just recently, which was some encouragement. But again, because it doesn't have the financials to back it up and support a valuation, which we need to be able to buy a stock like this, we can't value it. Therefore, the market's just lost interest again. And again, the time to buy it isn't after an announcement necessarily.
Yeah.
It's in those interim periods, that kind of stock, which will be news driven. But you've got to be a believer in the story. And I think, obviously, you've got to make sure that the market cap makes sense for the market opportunity. There's a sizable market opportunity. The market cap makes more sense than it's ever done, but it's a very risky kind of stock to invest in.
Yeah, good. Thank you, Jeremy. Now, that is all we have time for right at the moment. We'll be back with more after this short break. If you'd like to speak with our expert panel, call us on 1300 30 34 35 or email yourmoney@skynews.com.au.
To be a trader, you need that spark inside. The courage, vision, and determination. The eye to see opportunity, and the wit to seize the right one. IG.
Yeah, everybody over here, everybody over there. The crowd is live and I refuse this. Party people in the house, move.
By 2030, nearly 60% of us will call cities home. And if we're going to meet our needs, we're going to have to rethink so many things that touch people's lives.
So, how do we get there?
For us, the answer is social innovation that uses our advanced solutions along with IT to help create a social infrastructure for generations to come. Hitachi Social Innovation.
It's our future.
Hitachi, inspire the next.
Down here, there's a lot to take care of. There's the meetings, the deadlines, the phone call you promised your mother, your gym bag full of wishful thinking, and your 2-hour park in a 1-hour space. But up here, everything's taken care of.
Shiraz or Riesling, sir?
Especially you.
Shiraz, please.
With food, checked baggage, and entertainment now complimentary on Virgin Australia domestic flights.
Incredible, isn't it? Handcrafted in Paris. Got it online. But all I can think about are those damn foreign transaction fees you banks pile on. Way to ruin something beautiful!
You do realise none of our Bank West Platinum credit cards charge any foreign transaction fees, online or when you travel overseas.
Lucky I bought two then, huh?
We're making banking easier with Platinum credit cards that don't charge foreign transaction fees.
This is the future of mobility. This is reimagining the realms of possibility. This is the BMW i8, and it is these ideas that drive innovation in the BMW 5 Series. With BMW connected drive features, such as real-time traffic information and concierge services, you can experience the ideas of tomorrow today.
Welcome back to the program. I'm Ken Bloomfield from Financial Clarity. Joining me on the panel tonight is Jeremy Hook from TMS Capital and Gary Stone from Share Wealth Systems. If you have a question you'd like answered, call us 1300 30 34 35 or email yourmoney@skynews.com.au. We'll go straight to a caller from Brisbane. Richard, how can we help you tonight, Richard?
Yes, the share I'm interested in is Cocal. CKA. Cocal, it's an Australian coal miner starting a mine in Indonesia.
Yep.
And it's currently subject to a formal takeover offer for 16 cents. And the share price is languishing around about 8.3 cents. I just wonder what what you would think about that.
Okay, well, that's an interesting one, Richard. They obviously the market's a bit suspect over whether that takeover is actually going to go ahead or not, or whether the company doing the taking over actually has the cash to do it, maybe. Cocal, CKA, obviously a small cap stock. I might go to you, Gary, on this one.
It's tiny. Just technically, and I look at the chart here, it's what I call a dirty chart. People have heard me talk about it, where it's been pretty illiquid for some time. There's a bit of action that's just come into it in the last few weeks. But just technically, there is a support zone between 13 and 15 cents where it found support for some time. It fell below that late last year in 2014 and went all the way down to 4 cents. And obviously on rumour and story, etc., it's jumped from 4 to 12. But that support level has now become a resistance level. It's tried to get through there twice, it hasn't. If there's an offer on the table for 16 cents and it's trading at half of that, I'd be highly suspicious. It also only turns over around $40,000 a day. So again, it's tiny stuff. You wouldn't be, as a rule of thumb, you shouldn't be putting more than 10% of what their average turnover is on a daily basis. So you're talking there again about $3,000 or $4,000 is really what you should put into this, purely from a liquidity perspective. So if it goes up 50%, whoopee-doo. You're going to make 1.5, 2 grand. Now, sorry, I say that because it might be big to some people, but it's an out-and-out gamble. It really is. I'd be looking for.
And if it was 4 cents just 6 or 7 weeks ago, it could well be 4 cents.
It could go. It could halve. Yeah. So so you're talking about maybe making 1.5 grand to maybe losing 1.5 grand. Yeah.
Right.
So
okay.
You just cannot put more than 4 grand into the stock. You really.
So
can't.
you wouldn't be jumping on that horse. Maybe getting back down to Randwick.
It's just the volume, the liquidity is not there. There's no market here, effectively. It's like going to an auction at a house and there's 3 people there. That's not a market, and that's what's happening here. And that's the real risk. Besides all the other stuff you've spoken about, is there's no market here. There's no liquidity.
Okay, good. Thanks, Gary. Fantastic. Now we've got a email now from Anne. Anne writes, "At the rate I'm going, I would have been a lot better off getting 1% on my savings instead of investing in shares, losing more than 30% of my value of my whole portfolio. What would you recommend for retirees investing or cash?" Okay, and I'm not sure about what period you have invested over. It looks like you might have been invested just prior to the GFC, and then you're worried that you've lost value on those shares over that period of time. As a financial planner, what I'd say is that certainly a diversified portfolio and a well-constructed portfolio is probably the #1 issue with investing. If you invest all your money in cash and fixed interest, it may well be safer in the short term. That is, there is some capital stability there, but you're also guaranteed long-term to pretty much run out of your money. If you take any sort of 10 to 15-year period and you take a rolling period, and take it right back to 1900, you've outperformed with shares over cash or fixed interest. So no point putting all your money in cash or fixed interest. Again, no point putting all your money in shares either. You need enough liquidity in your portfolio to see you through a full cycle. So, for example, and we do this with our clients, we measure exactly what the liquidity in their portfolio is. We want that portfolio to be able to last 7 or 8 years without them having to sell 1 share. That is, you need to be making a choice to sell shares, not have it forced upon you, because the cycle can take up to 7 or 8 years from top to bottom, and indeed maybe even slightly longer. So it's all about portfolio construction. I think I've snaffled that one up myself as a financial planner rather than giving it to my guests. But what do you think there, Jeremy?
Yeah, it's an interesting question. I mean, losing 30% of your value is puzzling. Obviously, you've paid too much, maybe bought the wrong kinds of things. I think it's important that when we talk largely on this show about equities of all sorts, as small as Cocal and as big as Commonwealth Bank, there is a massive risk difference between these kinds of things. And risk is also borne out by the price you pay. So I know when we're investing money for people, sometimes we buy these because they're that we want to get because they're at the right value. These over here we wait. And things like Commonwealth Bank, I've been waiting 4 or 5 months to be able to buy it for clients who came to us as new clients. And today presents an opportunity to begin to get your toe in the water on some big, good quality stock. So if you're paying at the top, you've got a chance of losing more money than if you buy after falls. So these are the kinds of things, in addition to the good examples Ken's given about asset allocation, income projecting, making sure you've got the right level of individual assets within. And I think you can't just talk about the share market, lastly, as a single entity.
No.
It involves such a risk spectrum that you can choose where you want to be. And if you know what you're doing, you can choose very conservative, good returning stocks.
And a lot of it is about portfolio construction, isn't it, too? Getting the right mix of different assets. You know, Gary was talking about that in terms of just positions in different stocks. So it drills right from the top of asset allocation right down to the positions within those different sectors and how much you actually put in the stock.
Asset allocation or money management, and then at a lower level, position sizing within an asset class. I mean, all that is really the keys of the kingdom. So if you, that's what I study and research all the time, but, you know, we haven't got time to discuss that here. But I'm just picking up that, you know, that the caller isn't a sophisticated investor when it comes to stocks. So I would recommend that certainly you don't want to have it all in cash, all in shares, absolutely no doubt about that. But rather than going and constructing, there's a simple step before you go and construct a whole portfolio out of equities, and that's to look at exchange-traded funds. So you could go to something like the STW, which is listed. A lot of people think it's a stock. It's the ASX 200 exchange-traded fund. It mimics, tracks, follows the ASX 200. Now, to give you an idea, if you take where the ASX 200 is now relative to the top of the GFC in 2008, it's about 15 percentage points below its peak then. But if you take the ASX 200 accumulation index, which is the ASX 200 with dividends reinvested, it's about 20% above the high from the 2008 peak. So if all you had done was hold the STW for a portion of your capital and reinvest all the dividends, you'd be 20% higher than what the peak was back then. So the 30% you may have lost, well, that would be way ahead. So rather than trying to construct a whole portfolio, you can buy one exchange-traded fund with a portion of your capital and get higher returns.
Spread across 200 shares.
You spread across 200 shares, or you could get the SFL, which is the SFL, which is the ASX 50, and there's an ASX 20, and you could get some exposure to the market that way.
Fantastic. Thanks, gents. That's a very, very interesting question and one we could talk about all night. Now, we'll go straight to another call. We've got Matt. Brisbane's dominating tonight, but what's your question up there from Brisbane, Matt?
Yeah, it's going great. I'm just wondering your thoughts on EML, Emergence Group, and where they're going as a long-term business.
EML. Okay, EML is not a stock that I'm familiar with.
E-merchants.
E-merchants, right. Gary, might go to you for a bit of a technical
There's a bullish pattern forming. It's not making money. It's got a market cap of about 110 million. I will just quickly check the liquidity on this. It's trading about $170,000 odd a day, so there's sufficient there to have a half-decent size. But there's a technical pattern setting up here, which you don't see that often. It's called a cup and... it's basically a cup and saucer, or effectively there's a cup formed, which is a rounding bottom, and then now you've got the handle, a cup and handle is what it's called. It's in the middle of that handle now. Look for it to find support at around about the 67-cent mark. If it gets above 80, it would be a clear buy. So I'd be waiting until it rises and gets above 80 cents, so which will probably happen when we get some market weakness out of the way. So a very bullish pattern setting up here, and I'd be looking to be getting into that soon if it gets above 80 cents. Yeah.
Okay, good. Thank you, Gary. We'll go straight to another caller from Melbourne. Graham, how can we help you, Graham?
Yeah, thank you for taking my call.
Pleasure.
Now, I've been involved in shares in Worley Parsons, and the way the share market is at the moment, I'm making a reasonable loss. Now, am I better to cut my losses, and under the way the market is at the moment, to look at other stocks which are going to give me a better return? Or are Worley Parsons likely to, you know, come good in the near future?
Good, thank you, Graham. Now, I think the key term there is near future. I would say, should you be cutting your losses? I'd say yes, but I'm going to go straight to the panel. Jeremy, what do you think? I mean, this is a darling stock for years.
Yes.
Did fantastically. We owned the stocks for owned the stock back for the clients in late 90s, early 2000s, and sold out of it when it got to $7 or $8. We're already up 500%. Now it went all the way up to $30 or $40, and now it's all the way back to I think 12 or thereabouts now. Is it? 9, is it? Yeah.
The
tough gig though, isn't it, in this cycle?
The thing is, I mean, what highlights this case, Graham, is that Wally Parsons is not a buy and hold stock.
No.
The answer to the near term, I don't think is a good one, and I think we'll do better elsewhere in the market. But there'll be a time, I think, Wally Parsons will make good money and its shares will rise again.
And they're a well-managed business, aren't they?
But not as well as they could have been over the last couple of years, I don't think, Ken. Because I think the actions that we heard from them yesterday should have been taken 2 years ago.
Yeah.
And again...
Yeah, they're in denial, I think.
In denial, and nobody likes the end of a mining boom and a phase to end, but when you're in that business, you've got to know the cyclical nature and you've got to cut your costs hard when it's just beginning to turn against you. But Wally Parsons makes good money in good times. They will come again, but I'm thinking it's beyond 2 years, and so for mine, I'd be out of it and in something else.
Good, thanks, Jeremy. What do you reckon, Gary?
Well, if you've held on to it this long, I might give you a glimmer of hope, but you need to have a think about it, Graham. Well, firstly, the fundamentals, trading PE of 10.5, dividend yield now of 8.3, earnings yield of 9.5. You know, and these stocks are not certainly buy and hold forever, like Monadelphous and a whole bunch of others, right? It was a massive darling, and you got to get out of them at some stage. But the news on Wally is if you've been holding on to it the whole time, you're all the way up to $54 and down now. You've taken just about all the pain you can take. I'll give you a little bit, if you can handle a little bit more pain and set a stop at $8.50. Because it's at $10.20 now, so you're talking about $1.70. You're talking about 17% or 15, 16, 17%. You're about okay, because it's in the middle of a basing pattern, smack in the middle of it, and that basing pattern runs from $8.50 to about $12, and you're sitting in the middle of that moment. So if you can hang on and take a bit more of a gamble for another little bit, because you've already taken the whack. But if it gets below $8.50, then cut out. Then that's the pain you should get out. But there's a chance here this could rise above. This basing pattern plays out. It jumps out the range. I don't know when it's going to be. It's typically looking at the time it's taken to get to this basing pattern. You've probably got quite a few more months, probably the rest of this year, before it would probably break out the top. It'll be patience, but you've taken all the pain. If you can hang in there for the 15%, maybe you can get some decent upside out of this. You know.
Thank you, Gary. That's really interesting. I mean, you know, the big question there, I think, is how hard these budgets are going to be hit of the big majors, the oil majors. Wally's really hooked into the oil majors and their spending. My feeling is that that's going to take a little while longer to go through the cycle, but at some stage it's going to be a good buy. Isn't it?
And the other thing, of course, is that you know, when you look at your portfolio, you've got to do it unemotionally and objectively, and you've got to say, what is the best chance for the money I have left in my portfolio, regardless of what loss I'm sitting on,
and whether you hold the stock or whether you don't hold the stock.
What is the highest probability for growing the money I have in my portfolio right now from where it is? Is it in Wally Parsons or somewhere else?
Great.
But if you're hooked into it and emotionally you don't want to take the loss, well then I'll just give another option, and maybe you could do a bit of both. Hang on to some of it and take some of it and put it somewhere else. Yeah.
Fantastic. Well, we're talking a lot about portfolio management, money management, etc. tonight, aren't we? And we will continue to talk about that after this short break. If you'd like to speak with our expert panel, call us on 1300 30 34 35 or email your money at skynews.com.au.
Down here, there's a lot to take care of. There's the meetings, the deadlines, the phone call you promised your mother, your gym bag full of wishful thinking, and your 2-hour park in a 1-hour space. But up here, everything's taken care of.
Shiraz or Riesling, sir?
Especially you.
Shiraz, please.
With food, checked baggage, and entertainment now complimentary on Virgin Australia domestic flights.
By 2030, nearly 60% of us will call cities home. And if we're going to meet our needs, we're going to have to rethink so many things that touch people's lives.
So, how do we get there?
For us, the answer is social innovation that uses our advanced solutions along with IT to help create a social infrastructure for generations to come. Hitachi Social Innovation.
It's our future.
Hitachi, inspire the next.
It's easy to create my beautiful website with Wix.
Let's go again.
If only everything in business was as easy as Wix. Go to Wix.com and create your stunning website today. It's free.
You know how easy it is to now shop at Mitre 10? That easy. You get great online deals and collect them in store.
Easy to install wall panel heater, $79
at mitre10.com.au.
Wake up to something special. Makona.
We love watching patterns. We love spotting the little things that shouldn't be there. That's 9 so far. Our intelligent security systems can detect something odd in your spending pattern, helping to stop fraud in its tracks. Just part of the shopping with confidence service we deliver daily. American Express. Realise the potential.
Nice. Nurse? Sexy nurse? What's made it going as? Cat!
Trevor! 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 Trevor's in the tree!
I got this.
Accidents can be chaotic. Luckily, you can capture exactly what happened with our Amy Claim Assist app.
You can come down now, Neil.
I don't think I can.
You're with Amy. Want more? Get more at Nissan. With free stamp duty, free registration, free compulsory third-party insurance, and free scheduled servicing up to 3 years on selected model grades. See your Nissan dealer now.
Welcome back to the show. If you have a question you'd like answered, pick up the phone and give us a call on 1300 30 34 35, or if you prefer, you can email us on yourmoney@skynews.com.au. Go straight to Steffi from the Gold Coast. Steffi, how can we help you tonight?
Oh, hi, gentlemen. Thanks for taking my call. I've been sitting on the sideline just watching the share market for a while. I've got a reasonable sum of money I was wanting to invest, and I was wondering if you could maybe suggest, say, 4 stocks. It's really good value slash bargain buy at the moment. What I've been watching is Ramsay, Macquarie. I see Magellan's down today, and also I'm quite keen on getting some Combank as well.
Okay, good. Thanks, Steph. Well, that's a pretty good start, I reckon. Jeremy, what do you reckon?
I like all those stocks, really.
Yeah,
I noticed Magellan today fell because their funds under management marginally fell in the month of April for the first time in living memory.
Since they listed,
Since they listed, pretty much. So, but they're a very good returning stock. Macquarie, I think they're a good one. Look, some of those are probably, there's a fair bit of volatility in that collection of stocks. I'd just point that there's some more stable, sort of safer stocks as well. The moving parts within some of those businesses, you know, are certainly positive at the moment, but there'll be times when some things are going to be a little bit more consistent. You know, I like to think of things like Sol Pattinson and Wesfarmers as good single stocks for people to own because they're diversified by their very natures. They have a very strong shareholder focus and look after shareholders in the way they go about everything. So I'd include those, and I wouldn't rule out, you mentioned Combank, but I wouldn't certainly rule out looking at the banks in the mix there. But I think certainly some interesting names to start with, Steffi.
Jeremy, how many stocks do you think Steffi should be holding to get sufficient diversification?
Again, as she said, it's a reasonable size to begin with. She can certainly, if it is the case, and we have the same meaning of what that is, looking at somewhere between 8 and 12 stocks gives you a good diverse portfolio, and that's certainly when we wouldn't be less than that on a decent sized portfolio.
Yeah, good. And Gary, what do you reckon?
Well, you know, there's a whole bunch of things. We were talking about the investment plan earlier. You know, the plan you're going to have, which should have a mission, should have a set of goals and objectives, then how you're going to meet those goals and objectives, and then some little bit of detail on your routines on a daily, weekly or monthly basis. And so, you know, that's where Stephanie should start. It's like doing a business plan.
Yeah.
And she's talking about a fair sum of money, and it sounds like she's relatively young, so this is going to be for many years. So she should be doing that. And there's books and all sorts of things out to do that, and people you can phone up, I'm sure, and stuff on the internet. But, you know, a stock portfolio, if you really get into it and you learn the fundamentals and maybe a bit of technicals, and you do it pretty well, you're going to outperform all other asset classes over the long term.
Yep.
But while you're doing that, you don't want to sit on the sidelines and cash while you're learning, because the learning curve is many years, not many months.
Yeah.
So get some help, get some mentors, etc., etc. But I'd also, in the meanwhile, so you don't end up sitting on the sidelines for too long, Steph, is to look at exchange-traded funds as well, where you can get diversification immediately either into ASX 20, ASX 50, or the ASX 200, and you can look up the codes, the STW and the SLF are the ASX 200 and ASX 50, and then just reinvest the dividends. And that way you can start fairly low risk without having to become a stock picker straight at the get-go.
Fantastic. Thanks, gents. I hope that helps you, Steph. Now we'll go straight to Phil from Melbourne. How can we help you tonight, Phil?
Hi, gents. Thanks for taking my call.
Pleasure.
My question is on Tiger Resources. I've been watching the share for the last couple of weeks. It's sort of taken off over the last couple of days, actually.
Yes, the copper price has been very strong, Phil.
Interested in your thoughts about the share.
Good, thank you. Jeremy, Tiger.
Yeah,
not in a lot of resource stocks at the moment. I know you're talking about that, nor am I.
But what's interesting here is copper has definitely moved up. Well, I think it was up about 10% on Friday. It's
one of the strongest
absolutely,
in the last few months of all the quantities.
And the supply and demand dynamics are positive. I even noticed tonight at the meeting for the demerger of South 32, Graham Kerr, the new CEO of South 32, being demerged from BHP, he said we might be interested in buying some copper assets. South 32 don't own any. Copper is one of the major 5 parts of the new BHP billiton. So certainly copper is in focus. For Tiger, it's got a reasonable sized mine that's producing a little bit in Africa, okay? And so it's got some excitement value there. To me,
that's a nice way of putting it.
That's a nice way of putting it. My way of playing, I like Escondida and Olympic Dam, and they're the mega stocks. What I like about what BHP can do with its copper is turn what is the volatility of a cycle and us worrying about commodity prices, production, exchange rates, into a more predictable cash flow stream. And that's what's appealing, and that's why I like weakness in stocks like BHP to be able to buy.
And super A-grade assets.
Exactly. Tier 1 assets, long life, high grade, high margin, equals shareholder returns.
Fantastic, Jeremy. Thank you for that. Now, Gary.
I'm not typically a short-term trader. I'm more medium to longer term. But this is undoubtedly a short-term opportunity. There's been a breakout on volume. It's been in a downward trend for some time. There's been a basing pattern which preceded this breakout. Copper is looking very strong technically. It's got to a bit of a resistance level at the moment, but it is winding up here to be probably a short-term play. I think the resistance is going to occur at about 18 cents. It's sitting at about 8.99 cents. The buyers did not end up in control today. Sellers ended up in control, but it was up on the day. So there probably will be a bit of a pullback. But this looks quite positive for a short-term play, which may turn into a medium-term play before it gets to resistance at 18 cents. So I'd be putting a little, short-term, I'd put something into this. Absolutely.
Good, thank you, gentlemen. Now we have a call, I believe. An email. We have an email. Okay. Could you please let me know if it's worth buying Genworth now? So, gentlemen, Genworth, listed there a few years ago.
Last year, so they partially spun off. So Genworth, a US company, their local Australian business, which is in listed mortgage insurance, so lenders' mortgage insurance. A good business. Again, they lost a contract with Westpac about 6 months ago. Their listing, though, was at $265. That was way too cheap. They ran up almost to $4. They've pulled back to around $3.20, $3.30. Pay a nice dividend. Again, they've got to keep their contracts to make sense, but they're not a bad stock and a good play into the in lieu of the banks.
Fantastic. Quick one there, Gary.
This is a large cap stock. It's turning over 4 or 5 million a day. It's sitting right on support right now at $3.20. It's a new listing, only listed 9 months ago. Technically, this 320, 319 has to hold. If it falls below this, it's a listing, and my view is you look for a support or a resistance level to form within the first 6 to 9 months after listing. There's a very definite one here at 320, 319. Falls below that, you've got to cut it out.
Fantastic. Now, I think we have time for a very quick call with Will from Doncaster. How can we help you, Will?
Good evening. I'd like to know if Bendigo and Bank of Queensland are buyable, and a view on insurance companies, please.
Okay, now, gentlemen, we've got a short time for this one. So a quick one there on small banks or insurance companies.
Bendigo above Bank of Queensland for me.
Yep.
But I still probably see better opportunities in the majors.
Yep.
So that's my view. On insurers, QBE, and they had a presentation today, looking like they're turning the corner.
Yeah, it was pretty interesting presentation, wasn't it? I thought
it was a restated guidance.
It's good. Yep.
Looking interesting, yeah.
Great. Gary, quickly?
QBE was my hold tonight in the buy hold sell segment. Last month it was my buy. So on that one, I think it's going nicely. Both Bendigo and Bank of Queensland have been far stronger relatively than the large banks. They're both at key support levels and could bounce off those. So, yeah, again, comes down to money management. It looks like on the
capital adequacy side of things, they won't need to do as much work if APRA does force the
They're both off their highs technically, so they came off before the largest banks did, and they've sustained this in the last 3 weeks pretty well. And they're at support level, so there could be buy opportunities, but don't put the house in it.
Okay, good. So quite like the small banks there. Now, that's all we have time for today. Thanks so much to our guest, Jeremy Hook from TMS Capital, Gary Stone from Share Wealth Systems, and to you, our viewers, for all your calls and emails. Until next time, I'm Ken Bloomfield from Financial Clarity. Have a great night.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies